One of the benefits of owning real estate is you get to take what they call depreciation, which is an expense against your income every year. When you sell a building, you pay two types of tax. You pay capital gains tax and you pay depreciation recapture. I bought a $400,000 property. I did a cost seg study. It created a $150,000 deduction. If one of the main purposes of using your real estate is for tax deductions, be very aware of where you're buying your property. You probably shouldn't buy an oceanfront property in Malibu because
Hey, what's going on, guys? We got another exciting episode for you on the Commercial Real Estate Blueprint podcast. We got our guy, Eric Oliver here from CSA Authority. It's like CSA. We can get that part out. CSA Partners.
Yeah.
He's here to talk to us about cost seg, which is really interesting. Me and Graham have like zero experience in it. So we're going to be asking a lot of newbie questions, and I'm excited for Eric to really dig in here and tell us what tax implications and things that we can take advantage of through cost segs. So Eric, tell us a little bit about yourself for people who don't know you, and just personal background and how you got started in real estate and really taxes too.
Yeah, good question. So like you guys said, my name's Eric Oliver. I'm with CSA Partners. We are a kind of a niche accounting firm headquartered just outside of Salt Lake City, Utah. I've been here about 8 years in different roles. I've loved it. Kind of my background, I grew up here in the state of Utah, born and raised, went to college here. In college, math always came somewhat easy. Hated writing papers, still hate writing papers and emails. I can't do it. So in college, I'm like, hey, how am I going to get out of here as quickly as possible? So math was kind of the route for me. It was either a finance or accounting degree. Originally, it was a finance degree. And then I found out that if I did an accounting degree, there was a few less classes that I would have to take. So I'm like, okay, I'm going to do accounting. So long story short, I've got an accounting degree. I've never actually used my accounting degree. I'm not a CPA or anything. Kind of out of college, I ended up taking a sales job with a company that took me to Richmond, Virginia. So I lived in Virginia for about 12 years, selling to different companies headquartered in Virginia. Did that for about 12 years, then ended up in Long Island, New York. My father-in-law has a landscape company he's had for about 30 years, and he was getting ready to retire. So we went to Long Island, New York, and did that. He's like, hey, come up here. I'll teach you the business. You can buy the business in a year. Needless to say, I was there for 5 years. He never sold the business. So I'm like, wait, I think my wife and I made it a little too easy for him. He kind of was able to kind of sit back and we did all the work. He's like, hey, I don't need to retire. I can do this for another 10 years if these guys are doing all the work. So anyway, so my wife and I decided to move back to Utah. I had some aging parents. By that time, I had some kids. New York is great. I love New York, but not a great place to raise kids where we were living. And so I wanted to head back to Salt Lake. So was looking for jobs out here and came across the job for Cost Segregation Authority at the time. And honestly, I was looking at the description. It's like, you got to have some accounting background, some sales. And I'm like, okay, that kind of fits what I've been doing. Had no idea what cost segregation was. Literally had to Google it, watch a YouTube video before I interviewed to figure out what the hell it was. Anyways, that was about 8 years ago and have loved it. It's gotten me personally into real estate. Prior to working here, I had one long-term rental property. We kept our house in Virginia when we moved to New York and rented it out, but always interested in real estate. So working here, being able to meet different people, go to different conferences, talk cost segregation. I've been introduced to a lot of different investment strategies, real estate opportunities. And so I've gotten into real estate myself. I've loved it. Still love working in cost segregation, love working with people, but it's a great tool. It makes sense for certain investors to utilize it. And that's kind of how I got here.
That's awesome. Before we dive too much into like the details and the numbers and stuff, I've got to ask you, being in Salt Lake, are you a skier or a snowboarder?
I grew up skiing. Funny story. My first job was up at Alta Ski Resort. It's up by Snowbird. Most people probably know Snowbird. Alta Ski Resort is one of, I think, 2 ski resorts in the country where they don't allow snowboarders still. It's like pure skiing. Some of the best snow on the earth is up at Alta. But so my first job was up there. I grew up at the base of the canyon. So I was 20 minutes from the ski resort. Skied all the way through college. When I left to Virginia and came back, I'll tell you, when I was skiing through college, it was $20 for a day pass. And when I came back, it was now $150 for a day pass and probably $25 for a bowl of chili. So it was a little bit out of my price range. So I actually haven't skied much since I've been back. And I'm a horrible parent because I've got young kids and everybody's like, you got to get your kids into skiing. And I haven't. So
yeah, no, that's cool. Me and Jesse both went to App State, which is in Western North Carolina, and it's nothing like out west. I've heard. I haven't been snowboarding out west, but I think this is stupid to admit, but my primary reason for going to App State was so I could snowboard.
Oh, really?
I didn't tour it before committing. I didn't do anything. I was like, wait, like, cause at the time in high school, I was going up snowboarding, like trying to go as much as possible. And, I was like, wait, isn't App State right next to App Ski Mountain Beach and Sugar? And my mom was like, yeah. And I was like, all right, that's where I'm going. And so I applied and then I went there and then I ended up, thankfully it was, a phenomenal place and I loved it. But the main reason to go there was for snowboarding. So I'm a big snowboarder and I swear like the last 2 weeks, not even 2 weeks, last month on Instagram, all I see is everybody out west snowboarding. I'm like, goodness gracious, I want to go so bad. So I've got an itch.
Out here, let me know. We've got some great snow out here. So
yeah, I've been itching to get out there. In Park City, I don't know much about the different places, but I know Park City has some cool parks and stuff. I really like jumps and
there's a place called Woodward Snow Park, and it's up by Park City. It's pretty cool. It's all hoops and jumps and all that stuff.
Jesse, that's what I was literally just showing you that in the office the other day. It's like a trampoline park and they have foam pit. You can practice backflips and stuff. It looks awesome. That's like one of the main reasons I want to go to Park City specifically, but yeah, that's awesome.
We'll have to make the trip out there next year.
Yeah, we'll have to. For people listening and us too, explain what a cost seg is, like we're dummies.
So cost segregation really is just accelerated depreciation on your real estate assets. So one of the benefits of owning real estate is you get to take what they call depreciation, which is an expense against your income every year. So when you buy a residential property, let's say a long-term rental or an apartment building, anywhere where somebody lives, those get depreciated over 27 and a half years. So if I buy a fourplex, let's just say to make the math easy, I buy a fourplex for $275,000. I basically take $275 divided by 27 and a half, which equals $10,000 a year as a write-off. So I get a $10,000 expense every year as a write-off. It's a non-cash expense, but it does come off of my taxable income. So if let's say I make $100,000 a year, instead of me paying tax on $100,000, I've got this $10,000 write-off. I'm now only paying tax on $90,000. That's kind of how depreciation works. So that's called straight line depreciation. And again, for residential units, it's 27 and a half years. Any commercial unit, it's 39 years. So office buildings, medical space, restaurants, etc. So that's called straight line depreciation. That's what a lot of people do. They get a closing statement, they hand a closing statement to their tax preparer, and they just do that easy math, take it divided by the number of years. Cost segregation is, I want my deductions at a much faster rate. I'm probably not going to own my property 27 and a half years from now. And inflation and time value of money, I want all of my deductions now if possible. Well, we can't get all of them now, but we can certainly front load a bunch of them into these early years by doing cost segregation. And what cost segregation is just an engineering-based study where we go into the property and just as the name implies, we segregate the cost into different buckets. So for example, we'll use the long-term rental. You buy a rental property. When you buy that property, you're buying the land, you're buying the walls, the structure, but you're also buying all the appliances. You're buying the countertops. You're buying the flooring. You're buying the mulch out front. You're buying the grass. All those things that I mentioned, they don't last 27 and a half years. And the IRS actually has a book that tells you how long each of those assets last. So carpet is a 5-year asset. And I shouldn't say how long it lasts because there's stuff that doesn't make any sense. Like a roof is a 27 and a half year asset, but most roofs don't last 27. It's just these categories that the IRS places these things into. Your landscaping, for example, if you plant a tree out front, that tree is a 15-year asset. Well, that tree is obviously going to last a lot longer than 15 years if you water it and take care of it. But those are just the buckets that the IRS has approved. So we go in and we say, okay, we'll use that same example, your $275,000 purchase price, $12,000 of that was for carpet, $8,000 of that was for appliances, $28,000 of that was for the concrete out front in your driveway. So we segregate the cost into different buckets, and that allows you to depreciate it at a faster rate because now we're taking our carpet and whatever that $12,000 carpet is, we're depreciating that $12,000 over 5 years versus spreading out that $12,000 over 27 and a half. So at the end of the day, if you own your property for 27 and a half years, you're getting the same amount of depreciation. We're just front loading it into those early years. And again, there's a number of reasons why you want to do that. There's time value of money. There's inflation. There's, you're not going to own the property for 27 and a half years. So give me my deductions now versus letting the IRS hold on to them over the course of 27 and a half years or 39 years for.
Yeah, that's always a good reason to do something. let me have my money instead of the government.
Right.
I think most people investing in commercial real estate can agree with that statement. But
Yeah. Take that or that tax savings, go reinvest it in a new property, pay down your debt. There's a number of things you can do with that money. So you got it.
So I got a question, and this is a genuine question. So like we bought, and we'll get into the specifics of our property later, but like what are some reasons why somebody wouldn't want to do one versus why they would want to? Like, I guess weigh both. I mean, you might say they shouldn't, or there's not any reasons, but I've heard a lot of arguments and I still don't comprehend why yet. I'm still kind of processing it all, but like why you wouldn't do it. I'm still kind of fuzzy on that. And I'm sure people listening are too.
There aren't a lot of reasons why you wouldn't. It's more of a timing issue. So if you don't have a large tax liability this year, but next year you think you're going to make a lot of money, or you're going to sell a business, or you're going to sell properties, and so you're going to have a lot of income next year, maybe you don't do the cost segregation study this year because you might be in a 20% tax bracket this year, but you're in a 37% tax bracket next year. So let's say the cost segregation study generates a $100,000 deduction. If you use that $100,000 deduction this year when you're in a 20% tax bracket, then you just reduced your tax liability by $20,000. If you wait to do it next year when you're in a 37% tax bracket, you've now reduced your tax liability by $37,000. So it's more of a timing issue than whether or not you should. Now, there are some properties that don't make financial sense because you do have to pay for a study. These aren't just... It's a pretty intensive process to get a study done, an engineering-based study. So you want to make sure that your tax savings is greater than what our fee would be to conduct the study. So I'll give you an example on fees. For single-family homes, we're right around $2,800 to $3,200, and then it goes up from there. So we do single-family homes for $3,000, but we also do office complexes for $50,000. So that's a wide range. It just depends on the size and scope of the project. But if I'm going to charge you $3,000 and you're only going to save $2,000 in taxes, well, then it doesn't make sense. Now, that case doesn't really ever happen unless you're buying really inexpensive properties. So if you're buying a $60,000 home in downtown that needs a ton of work, that $60,000 home might generate a $4,000 or $5,000 tax savings. So does it make sense to pay $3,000 if you're going to get a $4,000 tax savings? Probably not, unless you're going to hold the property forever. The reason I say that is there's something called recapture, where you actually end up paying some of this tax savings back when you sell the property. Now, the longer you hold the property, the less you pay back. So if you end up holding it for 27 and a half years, you pay very little back. But if you were to buy a $100,000 property this year, do a cost study. So let's say you buy a $100,000 property, you save $8,000 this year, but then next year you turn around and sell it, you're probably going to pay $6,000 or $7,000 back in recapture tax. So let me just talk a little bit about recapture because I think I'll try to simplify it. But when you sell a building, you pay two types of tax. You pay capital gains tax and you pay depreciation recapture. Your depreciation recapture is based on how much depreciation you've taken in the building. So I'm telling you to take as much depreciation up front, which some people will say, well, Eric, that means I have a bigger tax bill when I sell it, right? And the answer is not necessarily. And the way that works is if I'm in a 37% tax bracket today, I'm saving money at 37%. When I sell the building in a year or two, I'm paying it back at a recapture rate of 25% and saving the spread. So I take my deduction at a high rate, I pay it back at a lower rate and save the spread. So that's the first thing. The second thing is, and then I think I'll back into it because I think it makes more sense. But let's say I buy this office building for, let's just make the math easy, $1 million. And I hold it for 5 years. And in 5 years, I sell it for $2 million. When I settle up with the IRS and I pay my taxes on that transaction, I'm telling them that everything's doubled in value, right? I bought this land, this walls, this carpet, these window coverings. I bought all of the parking lot. I bought all this stuff for $1 million. Everything is doubled in value. I'm now selling all this stuff for $2 million, and they charge me tax on that gain. Well, my land has gone up in value. My walls have gone up in value, but my carpet that's 5 years old, it's dirty, it's stained, is not worth double what I paid for it. If you remember, I mentioned earlier, carpet's a 5-year asset. So carpet, after owning my carpet for 5 years, it's fully depreciated down to zero value. So I should be selling my carpet in that transaction for zero and saying, hey, what you're really paying for, that gain from $1 million to $2 million, that's because the land has gone up in value, my walls have gone up in value, but certainly my dirty stained carpet hasn't doubled in value. So when you do cost segregation, it allows you to allocate the sales price to the right buckets. And when you allocate the sales price to the right buckets, then it lowers your tax bill upon sale. That's where you're actually taking it and putting it into the capital gains bucket. And that bucket's only taxed at 20%. So in summary, you're taking your deduction at 30 to 37%, you're paying it back somewhere between 20 and 25%, and you're saving the spread. And you're not paying it all back. It depends on how long you own it. You pay some of it back.
That makes sense. I had a question. So is that 25% recapture rate, is that just set by the IRS, or does that depend on income?
Depends on income. So it's up to 25%. So if you're only in at 20%, then it caps at 20%. It's up to 25% of your ordinary income tax bracket. Now,
got it.
Some of the assets that are segregated, not to get too far in the weeds, do get recaptured at ordinary income rates up to 39%, or excuse me, 37% currently. But if you've held it for a couple of years, those are the assets that you no longer have to recapture. So carpet, for example, is considered personal property. That gets recaptured at the higher rate. But if you've owned the building for 5 years, you're not paying any recapture tax on that.
Because it's fully depreciated.
It's fully depreciated, exactly. So
got it.
That's why when you do cost segregation, and a good cost segregation company is going to run you through this analysis before they ever engage you to do a study. Like we always will look at your building and say, okay, give us the details. When did you buy it? What'd you pay for it? How long have you owned it? And we run an analysis to say, okay, we can increase depreciation by $200,000. Do you plan on selling it? I don't plan on selling it for 3 to 5 years. Okay, well then in that case, yes, it makes sense. Okay, we're going to increase it by $200,000, but I plan on selling it the next 6 months. Well, in that case, you might save a few dollars, but it's probably not worth the hassle for you. Just do the cost segregation on the next property. So we'll run through that analysis. That was a very long answer to your question. Does it ever not make sense? But it's usually a timing issue more than anything. If you're buying buildings that have a depreciable, we call it a depreciable basis. What that is land is not depreciable. So when you buy a building, you always have to take out the land value. So land is usually around 20%, give or take, depending on where you're buying property. But if you buy $1 million property, you take out the land value, so that's 20%. So you have $800,000 of what we call depreciable basis. You should always look at doing cost segregation if your depreciable basis is above about $200,000 to $250,000. If it's below that, it may not make sense. If it's above that, it probably does make sense. One other caveat to that I do want to mention is there's something called passive income versus active income. So I'll give you a real life example. I am a W-2 employee here at Cost Seg Authority. So I get a W-2 at the end of the year. I have a long-term rental that I rent out. If I do a cost seg study on this long-term rental, those deductions are considered passive deductions because I do it on the side. Those deductions cannot be used to offset my active W-2 income. I can use those deductions to offset my rental income. So if I make $30,000 in rental income and I have a $20,000 deduction over here, I can offset that income. Now I'm only paying tax on 10, but I can't take these deductions over here and offset my active W-2 income. There's a few ways around that. One of them being if you're a real estate professional. So you guys have probably talked about that. Yeah. So if I was married, I'm not married to a real estate professional. My wife is actually in the school district, but let's say my wife was a realtor and that's all she did for a living. And we filed a joint tax return. The IRS says, well, those deductions now can be considered active because your wife is an active real estate professional. So those deductions can be used to offset my W-2 income and all my wife's commissions and everything else she would make as a realtor. That's one way. To be a real estate professional, you basically have to spend 750 hours a year doing real estate. It's about 14 and a half hours a week. But you also have to spend 51% of your working time. So if I'm a 40-hour-a-week guy here at Cost Seg Authority, then I'd have to spend 41 hours a week doing real estate. And that's the IRS isn't going to believe that. They're not going to say you're working 80 hours a week, 52 weeks out of the year. So basically, if you have a full-time job doing something other than real estate, you can't qualify. But if you're married and your spouse is part-time or doesn't work, they manage your properties. Now they qualify as a real estate professional. And now these deductions over here from all this depreciation and cost segregation, they can be used to offset my W-2 income. That's the first way. Second way is something called the short-term rental loophole. I don't know if you guys have heard about that, but again, real life example, I had in 2022, I had a tax liability and I needed some deductions. So at the end of 22, I went out and bought a short-term rental, not a long-term rental. It has to be short-term, so like Airbnb type properties. Because the average stay is less than 7 days, and because I manage that property myself, the government, the IRS, looks at it like, well, Eric, you're basically running a hotel. You have a hotel business. That gets treated very differently than me having rental properties. Because I'm actively managing my hotel business, those deductions from that short-term rental can be used to offset my active income. So I was able to buy a property. I put $80,000 down. I bought a $400,000 property. I did a cost seg study. It created a $150,000 deduction. I was able to offset my income that year by $150,000. So if I'm in a 30% tax bracket and I offset it by $150,000, that's a $45,000 tax saving. So of my $80,000 I put down, I got a refund check for $45,000 of that by doing cost segregation. So really, I only put down $35,000 on a revenue generating property that now is going to create cash flow. And actually, it does okay. It comes in a little bit above even, but really, I wanted it for the appreciation of the tax play, because now that property is going to appreciate over the next 10 years. I'll sell it, and I paid much less in tax. I could have given my $80,000 to the government. Instead, I put $80,000 down and got $45,000 back. So that's the other way, is a short-term rental loophole, they call it. It's really not a loophole. It's just understanding the tax code. Yeah. And then the other thing I will add is, if you ever sell a property, you can, if I sold my long-term rental and I had a capital gain, I could use my deductions from that property to offset the capital gain. So those are kind of the three times when, if you're not a real estate professional, there are ways to utilize those deductions to offset different types of income. You just want to make sure you work with your tax preparer and understand those.
Just real quickly, because we have an Airbnb that I don't actually know if we have a lot of short-term stuff, but I'm not sure if the average stay is below 7. If it's above 7, it's not treated as a hotel. Is it treated as long-term then?
It is, yeah.
Okay.
That is a key thing. The definition of short-term rental, or it's more like a hotel, is that the average stay is less than 7 days. So what you just have to do is we had 30 different people rent our property this year, and the number of days it was rented was 200. So you take 200, divide it by 30, and if that's less than 7, then you can qualify it as a short-term rental. The unique number of guests times the number of days it was rented out, or divided by the number of days it was rented out, will give you that number.
Okay. Yeah. We need to look into that.
I have a question. So let's kind of run through a scenario. Like, we just bought a building and we actually engaged somebody to do cost seg. Like, before we met you, it was several months ago. So hopefully it was the right decision, but we'll find out here. We bought the building for $250. It's a small industrial building. We bought it for $250. When we were sending in all the paperwork for the cost seg, they were asking, for the contract. They also asked for like the appraisal. It appraised at like, I think $350, $340, something like that. So it appraised for more than the purchase price out the gate. We also filled it with a tenant now, and it's probably worth a lot more than $350. Yeah. But question, when they do the study, is it based on the contract last purchase price, or is it based on that like market value / appraisal value?
Great question. So it is based off of your purchase price. So the IRS doesn't allow you to depreciate anything that you didn't actually pay for.
Got it.
You got a good deal on the property.
Yep.
And so that's kudos to you, but you only get to depreciate it at the $250 minus the land value. So,
yeah. So you mentioned if it was like near $250 or $200, it probably wasn't worth it. So in this scenario, I guess, do you think it would be worth it, or walk us through how that would look for us, like potential deductions and stuff?
Sure. So that's a great example. Let's walk through that. So let's say you bought it for $250. Let's say land is worth 20%. So that's $50,000. So you basically, have $200,000 worth of depreciable basis. So when we do our cost segregation study, on average, we segregate around 30%. So 30% of 200,000 would be 60,000. So we're going to go into that building and we're going to find $60,000 worth of stuff that shouldn't be depreciated over 39 years. It should be depreciated over a shorter useful life, either 5, 7, or 15. Those are kind of the buckets. So if we segregate 30% of that, there's something called bonus depreciation. So currently, when did you buy the property, in 23 or?
This was like 3-4 months ago.
Yeah.
Okay, so let's call it 24. So in 2024, bonus was at
60, right?
Yep, 60%. I have to do that in my head. So bonus depreciation, let me just talk about that, and then we'll go back to your example. But bonus depreciation, the government uses bonus depreciation to stimulate the economy. So when the economy's not doing well, they used to increase bonus, and that encourages people to go out and buy stuff. So if bonus was at, let's say bonus was at 50%, and I bought a $1 million bulldozer, essentially I get to depreciate 50% of that $1 million or 500,000 in the first year. So I get a big, huge write-off in the first year. And then the rest of that, the other 50%, spreads out over the useful life of that bulldozer. So you can see how that incentivizes people to go out and buy stuff when they increase bonus. So with the Tax Cuts and Jobs Act of 2017, Donald Trump was the president. Donald Trump owns real estate. And Donald Trump, when he revised the tax code, he made it very favorable to real estate investors. Two things changed. One is at the time it was 50% bonus. They changed that to 100% bonus. So any assets bought between September 27th of 17 and 12/31 of 2022 were eligible for 100%. Then it slowly phases out. Anything bought in 2023 was 80%. Anything in 2024 was 60%. That's the first thing. The second thing is the old rules of bonus only applied to brand new assets. So you couldn't buy a used industrial building. You would have had to build a brand new industrial building for it to be eligible for bonus. But in the tax code, they were really slick how they did it. They added 5 words to the tax code that made that change dramatically for investors. So they added new to you, the taxpayer. So now I don't have to go buy a brand new bulldozer. I can go buy a used bulldozer. It's new to me, the taxpayer, and all of a sudden I'm eligible for bonus. So in your guys' example, you just bought an industrial building. It might have been built in 1980. It doesn't matter. It's now new to you guys, the taxpayers. So you're eligible for bonus. So in your case, you bought it in 2024. You're eligible for bonus at 60%. So if we segregate, what did we determine? We segregated
30%, you said?
30% of 200,000. So that's 60,000. Now, of that 60,000, you're going to get 30% of that all in the first year.
Because that's a 50% bonus.
60%.
Okay. So like maybe a little more than 30,000.
No. So you've got a $60,000 deduction.
Okay.
You got 60% bonus. So if you take 60% of 60,000, my math. That is, what is that? 60% of 60,000.
36,000.
36,000. So you're going to get a $36,000 write-off in the first year. The rest of the stuff is going to spread out over each of the individual class life. So all your 5-year stuff, you're going to spread the rest of it out over the next 4 years. All your 7-year stuff, you're going to spread the rest of it out over the next 6 years. So you're going to get a $36,000 deduction. So if you are in a 30% tax bracket, take 36,000 times 30%. That saves you about $11,000 in taxes. So I don't know what you paid for the study, but as long as you paid less than $11,000 and you're not going to sell the building in the next couple of years, you're going to come out ahead.
Yeah, I think it was. Do you remember how much it was, Jesse?
It was like
25 or something like that.
I can't remember.
2,000, 2,500, something like that.
Yeah. So you guys paid, $2,500. You're going to save $11,000 roughly, and so you take that money that you saved, you go pay down your debt, you go put it down on a new property, what have you. But yeah, that's in that case, it absolutely works.
Got it. So in the scenario of the 60,
1 second, Graham. Assuming you're in a 30% tax bracket, if you guys were in a 10% tax bracket, that $36,000 of depreciation, it only equals $3,600 of tax savings because you're in a 10% tax bracket. In that case, it's probably a wash. You paid 25, you saved 35. I probably wouldn't suggest it if you were in a 10% tax bracket. But my guess is a couple stallions like you guys, you're probably tax bracket than 10%. So
not 10, thankfully. But so I guess going back to that example of 60 grand, if there was no bonus, because I still am kind of confused on the bonus depreciation. If there was no bonus depreciation, that 60K would just be spread out over the useful life, like the 5, the 7.
Some of it would be spread out over 5 years, some of it would be spread out over 7, and some of it over 15, which means that $11,000 of tax savings, it would basically take you at least 5 to 7 years to get most of that tax savings. So if you weren't going to hold it for 5, or you might save an extra $1,500 in tax the first year, an extra $1,500 in tax the second year. So if you're going to hold it, you would probably still do it. But I will tell you, prior to bonus depreciation and these tax law changes, we didn't do a lot of properties that were $250,000. It was mainly properties $500,000 or greater.
Got it.
But since 2017, with bonus depreciation and stuff, all of a sudden, that's an $11,000 tax saving. Now think about if you would have bought that property when it was 100% bonus. You would have got that full $60,000 write-off all in year one. So if you're in a 30% tax bracket, now that's 30% times 60. That's $18,000 of tax savings instead of 11.
Okay.
Good news is bonus depreciation hopefully is coming back to 100%. So there's been talks. There was actually a bill proposed at the beginning of last year by Congress. It actually got bipartisan support in the House. They were going to extend bonus depreciation through 2025 at 100%. Made it through the House with bipartisan support. It got to the Senate. There was a few senators that said, hold up, we're in the middle of a presidential election this year. If we pass this 100% bonus, it's going to look good for Biden and his guys. So let's hold off and let's not pass it until after the election. So the election's over. I think they've already talked about putting together a comprehensive tax bill. Unfortunately, I don't think it's going to happen for stuff that was bought in 24. So for you guys that are filing your taxes here in the next couple months, your property that you bought in 24 is probably going to be stuck at 60%, which is fine. That's still very good.
Right.
My guess is they're going to pass something before the 2025 tax filings, which before next year, and they're going to extend the 100% bonus. So that'll be good for all investors if that gets passed. And my guess is it will, but we'll wait.
Yeah. And you think there's a chance though that it could come 100% could be retroactive to 2024, right?
I don't think so. The reason for that is people are going to start filing their taxes here. I think you can start filing like February. Well, here in a couple of days, I think. They open it up like mid to late February.
Yeah.
But once people start filing, if they retrodate it, then they're going to have to be a lot of amended returns. Usually what happens with these tax laws is they need to be passed by January because all the tax software companies need to update their software. So when all the CPAs, tax filers, so we're probably too late. All the tax software has gone out. All the updates have been downloaded. So it's probably too late for 2024. But my guess is anything you guys buy this year will probably be eligible for 100% bonus. Cross our fingers. If not, it phases it. The current tax law is at 40%. So plan for 40, but know that chances are it'll probably be 100.
So can you walk through like how people get in trouble with recapture again? Because I know you explained it a little bit, but it can get pretty confusing. So tell us, maybe give us an example of how somebody you've seen has gotten in trouble with recapture.
So I don't think you can really get in trouble with recapture unless you're buying. Well, I'll give you guys, this is a good example for you guys. So you guys, we'll use your same example.
Okay.
I've kind of run the numbers. I found that any property over $500,000 of depreciable basis, it's worth doing a cost segregation study, even if you're only going to hold the property for 1 year. You're probably going to come out ahead. You guys could potentially, let's say you decide to sell that asset next year. So you bought it for $250,000. You did a cost seg study. We determined you're going to save about $10,000 in taxes, give or take. Let's say you sell that property next year. Because you've done a cost seg study, there's going to be there's recapture whether you do cost segregation or not. But because you've done cost seg, your recapture tax on that asset, if you were to calculate your capital gains and your recapture tax, if you were to sell that building next year, your recapture tax could be somewhere between $7,000 and $8,000. In recapture tax. Now, had you not done the cost seg study, you might only pay $2,000 or $3,000 in recapture tax. So because you did the cost seg study, you've taken all this depreciation, you've reduced your depreciable basis when you sell the building. Because you bought it for $250,000, you had all this write-off, so that means you're going to have a larger capital gain. So, for example, in that case, if you guys were to sell that building next year, the IRS is going to say you owe us $8,000 in recapture because they're going to say you took all the benefits of your 5-year bucket, but you only own those 5-year assets for 1 year. So give us our other 4 years back. Does that make sense? And when you calculate that, I don't have the exact numbers without running it through some calculations, but it's probably going to be $7,000 or $8,000. So if you paid $2,500 for a study, you saved 11, but then you sell it next year and you have to pay 8 of that back, you're kind of at a wash.
Got it.
Yeah.
Did you lose money? No, you didn't lose any money, but it probably cost time and effort to get the cost seg study done. Maybe you had to pay your tax preparer to interpret the study. There was probably some cost there. So in that case, it probably wouldn't make sense. So when I advise clients, I say, okay, if you are near that 200, 250, let's make sure that you're in a high enough tax bracket that you're saving a significant money up front. Because remember, if you guys would have been in a 10% tax bracket, you would have saved $3,600, and then you would have got yourself in trouble if you sold it next year because the IRS says you owe us $7 back. Now you're at a negative. But so you have a tax bracket, and then number two, anything under about that $500,000 mark, if you're not holding it for at least 3 to 5 years, you're probably going to break even or come out a little bit ahead. But as long as you're holding it, if you guys plan on holding that industrial property for 3 to 5 years, it was the right move. You're gonna come out ahead, no problem.
Yeah, I think we are. We're planning to. I think. And this might be a dumb question, but it's perfect. We're talking about the recapture stuff. If you do a 1031 exchange, so let's say we sell the building and we roll into something else, do we have to pay recapture tax if we're 1031ing? Or does that just build up?
Nope, it just builds up. So one of the great benefits of the 1031 exchange is, let's say you guys decide next year you want to sell that property because you need the money to go buy a better property.
Mm-hmm.
You can 1031 exchange. All the capital gains, all the depreciation recapture gets moved or kicked down the road basically into the new property. So as long as you invest in a property with greater value, so you take this $250,000 property, you roll it into a $500,000 property, that extra $250,000 of new basis, now you do the cost seg study on that. And you just keep doing that. So that's a great investment strategy that people do quite often is defer, meaning 1031 exchange, 1031 exchange, 1031 exchange. Unfortunately, we all die at some point. We die, our estate will get a step up in basis and nobody ever pays tax. So for you guys, let's use that as an example. You take this $250,000 property. In 5 years, you buy a $500,000 property. In another 5 years, you buy a $500,000 property. You keep doing that for the next 60 years until, unfortunately, you guys both pass away. Your estate now has $10 million worth of assets. They get a step up in basis at the time of death, and they don't have to pay any taxes. So you guys took a $250,000 investment. It grew to a $10 million investment, and nobody pays tax on any of that gain.
They like to call it, what I've heard, swap till you drop.
Swap till you drop. There you go. That's exactly right. That's an investment strategy that a lot of people will use.
Yeah.
You build wealth quicker that way.
Yeah. And the cool thing about that, there's a guy I follow, I'm sure a lot of people have heard of him, Ben Mala. He's on YouTube. He's a big personality. He's hilarious, but he talks about swap till you drop. And nice thing about that is, let's say, for this $250,000 building, we put 60 and up for the down payment. So let's say we put that $60,000 in there, but then we go 1031, we created value and equity. We buy another deal at 500. You never touch your nut. You never touch the bit you put in there, the 60K. You just keep building and growing. But so, on paper, some people think, oh, well, you never get to see that money. But what you're doing is ideally you're buying another good deal. You're adding more value, and then you're upgrading your cash flow stream. Yeah. Right. So let's just say you're making like $3,000, or let's just say you're making $1,000 a month in cash flow off of a $250,000 building. Well, the next one, ideally you make $2,000 in cash flow. And then you keep doing that over and over and over again. So you never touch the nest egg, but you're living off the cash flow. You're getting the tax benefits of the cost seg every time. You're getting, bazillion different things. You're paying down the debt. So that's kind of another piece to that strategy.
Yep, you got it. That's exactly right. So 1031 exchange, 1031 exchange, 1031 exchange, die, get a step up in basis. No one pays tax. Everyone's happy.
Yeah, and then your kids can take it, and if they want to sell it because they don't want to manage real estate, they don't have to pay nearly as much taxes, which is cool. Yeah. Question: you said something about properties from 2017, I think, to 2022 could still be eligible for 100% bonus depreciation. We bought that duplex, which we operate as a short-term rental. I think it was the end of 2022. Could we go back and do a cost segregation study and get 100% bonus depreciation?
Yes. That is one of the great benefits of cost segregation is you don't have to do it in the year you buy the asset. You can actually kind of just keep it in your pocket. Again, maybe you don't have a high income year, so you just keep the cut. You just take your standard deduction, which you guys have been doing since 2022. You've taken your standard deduction. Yep. But now this year you guys decide, hey, we made a lot of money this year. We have a lot of taxes due. You go back, you do the cost segregation study on that old asset that was placed in service in 2022. We bring all the missed depreciation forward. You get to take that on your current tax return without having to amend any prior years. So there's a tax form. It's a 3115. It's called a change in accounting method. That does need to be filled out when you do what we call a look back study, because basically that form says, hey, IRS, it's kind of interesting. You're checking a box on that form that says you're going from an impermissible method of depreciation to a permissible method, telling the IRS, hey, we screwed up, IRS. we were depreciating our carpet over 27 and a half years. We should have been depreciating our carpet over 5 years. That's the correct way to do it. And because we made that mistake, you guys owe us X amount of additional depreciation. And the IRS looks at that as what do they call it? They call it a automatically accepted change. They don't have to go in and investigate it. They just say, yeah, you're right. Carpet's a 5-year asset. And so all that missed depreciation gets dropped on your current tax return without having to amend. Yes, you can definitely do that.
Cool. Jesse, do you have any kind of last final questions for?
Honestly, no. I mean, my mind is kind of like bogged down. I mean, like in the sense that like I'm learning so much here that it's like, man, we got to like sit down and like think about some of this stuff for a second for our own stuff. And I think this is like great. You're very knowledgeable on this stuff. It's very clear. And I think that using us as the big guinea pigs here for our audience is going to be perfect because it's like, oh, this is a real life example. Like it's not just something that we sat here and made up. Like this is what we're actually going through. Sure. And so I appreciate that.
Yeah, absolutely. Absolutely. And one thing I wanted to reiterate. So if someone's going out there right now and they're looking at buying a deal, let's say it's a $500,000 deal. I know you can't give an exact number, but you say like a rough estimate of what you think could be depreciated, and the cost tag is maybe like 30%.
Yeah. So kind of the quick way to do the math for what year we were 2025. So we're at 40% right now. Like I said, the government could change that tax law, but let's just run it at 40%. A quick way, kind of back of the napkin math on a $500,000 property, always back out land. So let's call land again, 20%. So now we're at 400,000. Take 400,000 times 30%. The reason we're timesing it by 30% because that's what we're going to find in the building. 30% of the $400,000 worth of stuff, we're going to put it into those 5, 7, and 15-year buckets. So 30% of 400,000 is 120,000, and then you're going to get 40% bonus on 120,000. So that's, give me 1 second. I got a calculator here. 120,000 times 40%. That's a $48,000 write-off in year one. That's a quick way to kind of get to the math.
Yeah.
You take purchase price minus land times 30% times 40%.
Got it.
And that's a quick way to get to it. Again, most reputable cost seg companies out there, they're going to provide a benefit analysis for you. We even do preliminary ones. So if you've got listeners or you yourself are looking at a property saying, hey, I'm thinking about buying this property, give us a call. We'll run some preliminary numbers and give you a better estimate. Because we actually look up actual land value. We're not just guessing 20%. We'll look up the land value.
Yeah.
Some assets get bigger depreciation than others. A big empty warehouse, you're probably not going to get quite 30%. But if you're buying a multifamily or a duplex, you might actually get 35 or 40%. So we'll get you a better estimate, but that's a quick kind of dirty way to get an estimate.
Gotcha. And then that was actually another thing quickly I wanted to ask. To actually get the land value, do they use the tax value? Like if you go on the tax card and just pull out the tax value of the land? Because if for anybody listening, if you go to the GIS or whatever, they're going to have a tax value and it's going to be broken into improved and unimproved land. Is that what you guys use?
Yes. Yes and no. So the answer is yes, we do look at county tax records. If the county tax records are not always up to date, and so sometimes we have to use a percentage. So let's say the county says the building is worth $400,000 and the land is worth $100,000, then we can use 20%, right? But let's say you bought the property for $7 million and the county says the building is worth $400,000 and the land is worth $100,000, we can't take $100,000 off your $7 million purchase price. We have to take a percentage and say, okay, that's a 20% land to building ratio. So we now need to apply 20% to the 7 million. So if your purchase price is close to what the total value is at the county, then you can just subtract that number off your purchase price. But if it's way off, the county hasn't been updated, then you're looking at a ratio that you need to apply to your purchase price. Got
it. And PSA, most of the time, the tax records are not accurate. They're normally way off. So
there's that. And another quick thing is, depending on where you're buying properties, you sometimes don't want to use the county. You want to use a third-party appraisal. So, for example, California loves their property. The counties think their property is worth everything. So you might buy $1 million home in California, and the county is going to say, well, the land is worth $900,000 and your building is only worth $100,000. And you're like, wait, I can't even build this for less than $700,000. So what are you talking about? But they will say that. In that instance, you want to get a third-party appraisal to come in and give you a true land value because that is very defensible to the IRS. The other thing that you can do that's not quite as defensible, but a lot of people will do, is run comps on raw land in the area. So if there is an acre lot next to your acre lot and it's just dirt and it's selling for $200,000, you can say, hey, LA County, there's no way that you can tell me that my dirt is worth $900,000 when there's a piece of identical dirt next to me selling for $200,000. And so in that case, I'm using $200,000 for my land value and $800,000 for my building. So that's an important thing to note. When you guys are buying properties, you always want to look at the land value, because land value is not depreciable. So if you're using your real estate, if one of the main purposes you're using your real estate is for tax deductions, be very aware of where you're buying your property. You probably shouldn't buy an oceanfront property in Malibu, because that land is worth a whole lot of money. You could take that same $1 million for the oceanfront property in Malibu. That might only get you, $100,000 of depreciable basis, because the land is worth $900,000. You take that same $1 million and you go buy 4 homes in Oklahoma where the land is only worth 5%. And now all of a sudden you've got $950,000 worth of deductions available to you versus the $100,000 over here. So use your money wisely. I mean, there's a whole, that's just one factor.
Yeah.
You want to buy properties in Oklahoma versus Malibu. You got to be able to manage them. There's a whole number of things, but something to consider is land value when you're making a purchase, because it makes a huge difference in the amount you can depreciate.
That's good. Awesome. Well, thank you so much. If people want to reach out to you, do you guys do nationwide? And, if so, what's the best way to reach out to you? And
we do studies in all 50 states. Please use this as a resource, guys. We're kind of a niche accounting firm. We don't do taxes at our firm. Don't call me and ask me about earned business income or child tax credits, because I don't know anything about that stuff. If you've got real estate or depreciation questions, I'm happy to help. You can get a hold of me from our website. It's just www.csap.com. That's Cost Segregation Authority Partners, but just csap.com. My phone number is 602-568-0032. That's my cell. Call me anytime. I think the weirdest question I've been asked is how to depreciate mule deer at a breeding facility in Wisconsin. And I didn't know the answer to it, but we were able to find them the answer and get them what they needed. So, please use this as a resource, guys. We're happy to help any way we can. Again, we'd love to. We run free analysis on all properties. So if you've got a property, your guys' duplex, somebody else has got properties, we're happy to run some quick numbers for you. We usually turn those around in 24 hours, give you an idea of what our fee would be and what your potential tax savings would be. We're happy to do it.
Awesome. Okay. Well, that's huge. Guys, take advantage of that free tool. We're going to check out our duplex. Probably we'll send you something right after this, but thank you so much for coming on. I learned a ton. Hopefully our audience did too. And thanks.
You're welcome. Have a great day, guys. Thanks for having me.
See you guys in the next one.